How to avoid behavioral bias as an investor. Have you ever made a money move that you instantly wish you could take back? Maybe you pulled your investments out of the market during a dip, only to watch it rebound a week later. Or maybe you held onto a stock that was losing value thinking it'll bounce back, but it continued to drop. So if you've experienced any of this, here's the truth. You're not alone, and you're not irrational. You're human. Hi, I'm Laurent Munier, partner and advisor at Safe Pacific Financial, and we specialize in helping Canadian business owners, high-income professionals, and families grow, protect, and transfer their wealth using proven, tax-efficient strategies like whole life insurance, corporate investment planning, and disciplined portfolio management. If you're new here, welcome. And if you've been here with us before, welcome back. Hit the subscribe button so that you never miss one of our weekly insights on how to build real, lasting wealth in Canada. Now, understanding behavioral bias, this is the silent threat to Canadian investors. And today, we're going to dive into one of the biggest hidden threats to your long-term financial success, which is behavioral bias. What is behavioral bias in investing? It's the psychological traps that influence how we make financial decisions. These biases are rooted in emotion, past experience, mental shortcuts, and they can cloud your judgment, especially in times of market volatility or uncertainty. Even the most seasoned investors in Canada are vulnerable to these patterns. And the cost: missed opportunities, unnecessary losses, derailed financial goals. At Safe Pacific, we help our clients build not just strong financial plans, but strong financial mindsets. Let's go over the top 5 behavioral biases that could be holding you back and how to protect your wealth against them. Number 1, anchoring bias. This is getting emotionally attached to the first number. So anchoring is when you fixate on a specific number, like the price you paid for a stock or a property or an investment, and you base all future decisions based on that number. So, for example, you bought shares of a stock at $100 and today they're trading at $75. Instead of reevaluating the fundamentals, you convince yourself to wait until it gets back to $100, even though that may not be realistic. But here's the thing. The market doesn't care what you paid for the stock. Your original purchase price shouldn't dictate your exit strategy. And here's an investor tip. Set a forward-focused, data-driven goal. Don't anchor your strategy to past numbers. Focus on where the opportunity lies next. Number 2 is loss aversion. So losing feels worse than winning feels good. So it's a psychological fact that the pain of losing money is about twice as powerful as the joy of making it. And that's why many Canadian investors sell their winners too early to lock in profit, and they hang on to their losers too long, hoping that they'll recover. But emotional investing like this erodes your portfolio's long-term performance. So here's another investor tip. Remember, volatility is part of the journey. A diversified investment strategy that aligns with your risk tolerance can help you ride out market dips and avoid emotional decision-making. Number 3 is recency bias. So thinking of the latest trend will last forever. So recency bias is when the recent events influence your expectations disproportionately. The markets have been going up for 6 months, then you'll assume they keep going up. There's a downturn that hits, you assume it's only going to get worse. This creates reactive behavior, like chasing hot sectors or panic selling at the bottom. The investor tip is don't let short-term headlines override your long-term financial plan. Think in decades, not in days. Number 4 is familiarity bias. So sticking to what you know and missing out. So many Canadians default to what feels safe. That could be domestic stocks, blue chip companies, local real estate. But concentrating your investments into one sector or company or region exposes you to other unnecessary risks. True diversification goes beyond familiarity. It includes multiple asset classes and global exposure. Here's the investor tip. Work with an advisor to build a globally diversified portfolio that's tailored to your goals, not tailored to your comfort zone. Number 5 is confirmation bias. Only listening to information that backs you up. So let's say that you believe interest rates in Canada are going to go down. You only read articles or watch videos that support this belief, ignoring those videos and articles that say otherwise. So this is confirmation bias, and it's one of the most dangerous traps because it limits perspective and it reinforces blind spot. So here's the investor tip. You want to seek advice that challenges your assumptions. A good financial advisor doesn't just agree with you, they help you to see around corners. And here's how Safe Pacific helps Canadian investors stay disciplined. So at Safe Pacific, we are a neutral, fact-based filter for your wealth decisions. Our job isn't to manage your investments or structure your insurance policies. It's to keep you focused on the bigger financial picture, especially when emotions run high. So whether you're building a corporate whole life insurance plan or extracting retained earnings through tax-efficient investment strategies or preparing your retirement income stream, we can help you to stay objective, we can help you to stick to your long-term plan, and we can help you to avoid panic or hype-driven decisions. We don't sell fear or fantasy. We build strategies that work, backed by data, backed by experience, and behavioral awareness. So here's the final thought. Building wealth requires mental discipline. The most successful Canadian investors aren't just great at picking investments, they're great at managing themselves. They understand that money is emotional, but success is logical. They have a system, they have advisors who challenge their thinking, and they don't fall into the traps or short-term noise. So if you're serious about building a long-term, tax-efficient wealth strategy in Canada, and you want an advisor who understands both the numbers and the psychology, book a meeting with us. Let's see if we can work together. You can go to our website at safepacific.com, and there you can fill out the form. That'll send a meeting to one of us, and we will reply to you within 24 hours on business day. And we can help to build your strategy with clarity, with confidence, and with control. So now, if this video helped, give it a like, subscribe to the channel, or share it with somebody who's investing emotionally and who maybe needs a second opinion. If you have any questions, leave them down below in the comments and somebody on the team will reply to you. And that's it for today. Thanks for watching, and we'll see you next time.